Hey guys, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Ben Fraser. Ben is responsible for capital markets at Aspen Funds, a macro-driven alternative investment firm, having raised over $100 million from investors over the past several years. Ben has experience as a commercial banker and underwriter, as well as working in boutique asset management. Ben is a contributor on the Forbes Finance Council, and he's also the co-host of the Invest Like a Billionaire podcast. Ben, my friend, welcome to the show.
Thanks, Dave. Super pumped to be on the show with you.
Yeah, no, this is awesome. I've been enjoying your podcast since you guys rolled it out. Some really great content in terms of trends, economic trends, and things that you guys are covering. But for the audience that isn't familiar with you or Aspen, how about we just start with a little bit about your background, your journey. Tell folks how it all started for you.
Yeah, well, my journey, I spent a nice stint in commercial banking. So, was on the dark side for a while and really cut my teeth in, learning how to underwrite deals. So I started as an underwriter, eventually became a commercial lender. And for those that aren't maybe familiar with banking, there's kind of two big worlds of residential and commercial. And so the commercial side is doing all the business loans, the real estate loans. And, I'd got from a mentor of mine early on, said, hey, it's kind of a great training ground to become an analyst and underwriter because you get to see kind of what's under the hood of all these deals, how these deals get put together. And then the really fun thing for me was, I had free reign to go look at the personal financial statements and tax returns of all these, super wealthy folks. And so, talking about the whole point of the podcast here, the kind of light bulb moment for me early on was realizing I would say 90% of these high net worth individuals that we were lending to as a bank had substantial holdings either in real estate or in a business that they owned and other alternative investments. And it was either one of those or both of those, right? And so to me, it was kind of a light bulb moment of, hey, this is really something I want to get into personally, and kind of seeing, what was kind of behind the scenes there, and then really learning how to understand risk, right? As a banker, your whole goal is to mitigate risk. You, as a lender, don't get any of the upside. You only have downside risk, and that's why if any of your listeners work with bankers, sometimes it can be a little bit of a stick in the mud because they don't get to participate on the upside. They only participate on the downside, and their margins are such that they can't have much downside risk that actually is realized, or else the bank goes under. So it was a great training ground, but as a kind of entrepreneurial personality, I didn't last super long there. It was just a little bit hard, right? And I kind of saw this path where a lot of people that started in banking, the commercial side, after about 5 years or so, if you don't leave, you kind of get stuck there forever, and that was like my worst nightmare. So I joined the more fun side, which is being on the equity side, raising equity, looking at deals, looking at the upside. But I've kind of always had this background in risk mitigation, looking at risk, breaking down what are the kind of key risks of a deal and how do you mitigate those. But now I'm going to have a lot more fun, making money when deals go well, and putting those deals together for our investors. So I joined Aspen Funds about 5 years ago. And so Aspen Funds, we've been going for about 10 years at this point. We started kind of as an opportunistic fund in the distressed debt space. So buying distressed residential mortgages kind of after the 2008 crash, and working out deals with borrowers, helping them stay in their homes. And it's really a very cool business model. And it was kind of initially, I would say, spawned by the Great Recession. And so our team has always kind of had this opportunistic lens in finding opportunities that are going to be supported by what's going on in the macro environment. And so, we've been doing those funds for 10 years. We continue to operate those very successfully. About a year ago, we've started branching out into other asset classes, and really kind of from a personal standpoint, we started deploying our own wealth. We could talk about kind of the deployment strategies that we use personally into these other asset classes that we were seeing, and we're seeing these kind of macro trends going on, which is a big part of kind of our thesis and ethos at Aspen. And we wanted to participate in them. And then we thought, hey, why don't we bring along our investors that we've built these great relationships with, we built a great track record with, and let's go do the heavy lifting for our investors, because most of them are passive investors. They don't want to go operate deals. They don't know what questions to ask sometimes, how to understand risk, how to do due diligence in a good way, how to avoid Ponzi schemes, right? And then we put the deals together and we invest alongside of our investors. And we've since, in the past year, I believe we've launched close to 10 different offerings and about 5 different asset classes that we really believe in. And the latest of which I just heard you're participating in as well, which is oil and gas, which I think there's a huge kind of mega trend that we're kind of at the beginning of here that we could talk about from a macro standpoint of the things that are going on. But that's kind of a little bit about us. It's kind of the long-winded version, I guess. But yeah, it's kind of how we got to this point.
Yeah, no, that's excellent. Do you have been a particular investment thesis?
Yeah, I mean, as it relates to oil and gas, or just generally?
Just generally for Aspen and, for yourself and the principals?
Yeah, so we kind of tag ourselves as macro driven alternative investment firm. And the kind of whole idea with that is we're really first top down investors, meaning we look at the big forces in the economy that are driving certain trends in a variety of ways. And so we want to look at macro trends, and macro to us means long-term secular trends that are supported by supply demand imbalances, driven by other factors that are going to be making these trends last longer than, say, a 6 to 3 year period. And so a lot of times economic predictions, it's maybe it's a crystal ball, no one really knows, but to a certain degree you can a lot of times see the trajectory that things are going to go if you can look at the basic economic fundamentals. And one of the partners at Aspen is also my father, Bob Fraser. He's been a macroeconomist for the past 2 decades and had an incredible track record looking at these kind of bigger picture trends that are going on. And we call them economic tides versus economic waves, right? We kind of see these economic waves that really more akin to the stock market. We have this massive volatility, valuations go really high, and then we have some inflation, interest rates go up, and everything crashes down. And it's a lot of these kind of ebbs and flows that are pretty hard to predict. It's a lot of it's based on sentiment, right? But the economic tides are fundamental economic forces that are not going to change with the whim. I kind of view it as, this is the Titanic that is going in the ocean. It takes a long time for it to kind of turn, right? These kind of big economic tides are like large ships, cruise ships, that they can't make a quick agile turn. It's going to take some time for it to make its course correction. And so we're focused on those. We kind of start top down. What are the big trends we believe in? And we could talk about some of those that we're kind of seeing here. And then we kind of go the next level of what are the asset classes that are going to benefit from those trends and the strategies within those asset classes. So, a lot of asset classes, or every asset class, is cyclical in nature. There's going to be times when it's good to be in an asset class. There's going to be times when it's not good to be in an asset class. And then when the kind of final step for us is finding the right partners that have the experience executing those strategies in those asset classes, and putting deals together for our investors. So that's kind of our top-down approach, when we're looking for deals that we kind of think are going to perform well.
Yeah. We have a very shared philosophy in terms of that as well. And I think it's interesting, right? Because we're all kind of conditioned by Wall Street and corporate America. I mean, it's all just, rapid results, I mean, what did the market do today? Nonetheless, a quarterly change, but how did it impact today, tomorrow? And then there's also all of these extenuating circumstances or impacts, let's say, from something that's happening in the global economy, or something not really correlated to the actual investment itself, right? And I always found that very frustrating when investing in traditional markets over time. And as I kind of gravitated into real estate myself, and you just look at, multifamily, you look at the trends, the macro trends for multifamily. Yes, there's going to be some kind of peaks and valleys, and, we're seeing interest rates rise and some changes we can kind of talk about here. But overall, from that supply demand perspective, right? Exactly like you're talking about, looking at the macro trends, there's just not enough housing in this country right now.
Mhm.
And the builders are way behind. They got even more behind during the pandemic.
Yep.
So for the foreseeable, next 5 to 10 years, there's a huge shortage in housing. And then you layer on top of that, going into strong markets, right?
Yep.
That have high job and population growth.
100%. You're exactly right. You hit on a lot of things there, but housing is a great example because we share the sentiment, right? And it's pretty obvious if you start looking at the data that the shortages are there and there's no real way to catch up, right? We continue to have population growth and we continue to have supply chain constraints. And we've already have a massive deficit of what we actually need to kind of be at a economic stasis point of supply and demand, and we're not building fast enough. Where the current kind of home new starts are not keeping pace with population growth and with new household formation. And so what we're seeing here, it's kind of a lot of people we talk with, like, oh, we're in a housing bubble. Houses prices have just skyrocketed the past 2 years. It's like, yes, but we're not in a housing bubble, and a lot of the reason that they've skyrocketed is the market is finally caught up to the economic fundamentals. We've been calling for a housing boom for the past really 10 years. I mean, we've been in single family housing, buying these residential mortgages, and we've been saying all along, housing is going to keep going up. There's just no way it can't go up when you have the replacement cost of a new home trading at such a high premium to existing home inventory, which is, non-existent for the past 3 years. There's only one direction that goes, right? And now you add on household formation, which has kind of been pushed off for kind of this millennial generation. They've kind of waited to form households till later in life for a variety of reasons. But household formation is a massive driver in demand for housing, as you'd imagine, right? If you're a single person living in an apartment, all of a sudden you form a family, and all of a sudden you have kids, you want to have your own space. You want to have kind of the American dream. And all those kind of demand side of things are continuing to grow. And meanwhile, supply is flat or, declining. And so that's a great example of kind of a macro trend, right? That's not going to change anytime soon. We can't just magically snap our fingers and all of a sudden have, $2 million new homes that are just magically appear, right? There's it's being exacerbated even more by the current economic supply chain challenges. So 100% agree with you on that.
Yeah, and another key thing, right? We talk about wealth strategy, and that's really, our core ethos around strategy. And when you look at how the ultra wealthy are investing, they're investing with strategies, right? They're not investing by the flavor of the week and
Yep.
moving things around. And when you align that to these macro trends that you have, one key thing is that you can sleep at night, right? And capital preservation is absolutely key. So by having a portfolio, right, that that you're aligned to, you can really weather these storms so much better, right? Because you're not getting
100%.
caught up in the ups and downs, right?
100%. We're looking at a deal right now that's in an opportunity zone, right? So I'm not sure if you're familiar with that, or
Yes.
your listeners are,
Yeah.
but it's a pretty cool program, right? It has to be a
Yeah.
good deal, but the tax benefits that have been created for opportunity zone are insane. Basically, if you can hold an asset for 10 years and you sell it, all the capital gains at that point effectively are tax free. So you talk about building, wealth strategy and tax plan and other things, that's a massive, massive benefit in looking at real estate investing, aside from getting all the benefits along the way. But you have to have a long-term mindset, right? To your point a minute ago, you can't just be investing on what was the last quarter's earnings, right? And how is the stock price going to react to that? And the short-term mentality, it's a very different, very, very different time frame. And it's for some people that's challenging, right? We've been conditioned to kind of have these kind of quick hits of dopamine based on how the market's doing, and we can see our portfolio in real time. But it's not conducive to long-term tax planning, and wealth building. And one of the things that was really, really illuminating for me, kind of when we started our podcast, Invest Like a Billionaire, the whole kind of concept is looking at how the ultra wealthy invest. And one of the biggest differentiators I found from the research I was doing in preparation for the podcast was most of the ultra wealthy, which are billionaires, family offices, pension funds, endowments, all these institutions and high net worths with really big net worth numbers are investing large portions of their net worth into private alternative investments. And that was surprising to me. The percentage was as high as 50, 60+%. Yale Endowment Fund was actually a pioneer in this space of basically kind of bucking the trend of investing in the markets and actually going and investing in private equity, doing a lot of real estate and having really heavy allocations here. And they've been like the top performing endowment fund for the past 20 years. And so it really kind of speaks for itself, the results. But when the average investor, retail investor, it's accredited investors, $1 million net worth, most of those investors are 95 to 100% invested in publicly traded stocks, bonds, mutual funds, right? That's just the norm. And it's really surprising, or it seems, very alternative to be investing in real estate or be investing in oil and gas or be investing in, other things that are going on. But the reality is that's what the ultra wealthy are doing. That's how they're, building wealth. That's how they're getting efficient tax planning. That's how they're transferring, legacy wealth across generations. And it's something that's really, really powerful concept to understand.
Yeah, 100%, Ben. And I think really, the way I look at it, really our investment thesis is really three-dimensional in nature, when you're approaching an investment, right? Which is, number one, you're looking for tax efficiency, right? With your investment, you're looking for predictable cash flow that's coming in. And then we're looking at some type of, potential upside, on the back end. But when you invest in the stock market, all you're doing is hoping that your stock is going to go up. I mean, unless you're getting involved in, trading and shorts and puts and everything, right? But 90% of investors are just hoping that the market can go one way, which is up. Right. But in this case, you can actually win, in three different areas. And that's why the ultra wealthy, have, up to 60% of their assets in, in these types of alternatives. And it's actually comical that they call them alternatives as well. Right.
100%.
Because, how should real estate's probably one of the oldest industries around, I don't know why they call it alternative. And it's probably because they can't sell it, right, as part of their
Yeah, it's hard to charge your AUM fees on a real estate multifamily property or something, right? And it's funny because another data source that I love is Tiger 21, which is, you're probably familiar with them. This is a group that you have to have, I think, $20 million of investable assets to join, and they publish on a quarterly basis the portfolio allocation of the aggregate of all their investors, and only 25%. On average across all the investors of this ultra high net worth kind of club is invested in public equities. 25%. I would view that as the alternative, right? That's actually the alternative investment, is investing in public alternatives, and everything else they're doing is private equity, it's real estate, it's hedge funds and commodities and other things. And so it's really, to your point, comical that is kind of how the whole, mass media wealth management system has created this expectation that that's the way it should be. One thing we've talked about in the podcast before is the liquidity premium, right? So the biggest knock that alternative investments that are privately traded or privately held get is liquidity or lack thereof, right? You don't have the liquidity that you have in the stock market or the bond market, which is 100% true. I'm not going to make the argument that alternatives are liquid, so you have to go in with the measure of understanding that there is that risk, and you have, liquidity risk, which you don't necessarily have in the stock market. But if you actually break down what's the premium you have to pay in real estate, for example, to get the liquidity, that you would want, right? And so that's kind of an easy way to think about how much you're paying for a publicly traded REIT versus paying for a private, say, multifamily syndication, right? So you can go look, and we've have an episode on our podcast about this, where we've actually looked at the price to book ratio of some of the most commonly traded REITs. So a REIT is a real estate investment trust. It's a vehicle that's used to purchase real estate and pass through most of the income to investors, and it's publicly traded generally. And those REITs trade at a premium to book value. And so book value is effectively, the balance sheet of assets. This is the value of the assets that we have in this REIT. And the price to book is, the premium that, or discount that is trading relative to those assets. And so a 1-to-1 ratio would be 100% of the price is equivalent to the value of the assets, right? That's pretty easy to understand. A lot of these, what would you guess is the average? I don't know if you heard the episode or not, but what would you guess is the average price to book ratio on these publicly traded REITs?
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, I wouldn't even begin to have an answer for that. It's
They
probably
trade
surprising though.
anywhere from 5 to 20 times book value.
Wow.
And that's kind of like, price to earnings ratio is a commonly traded valuation
Sure.
metric. So basically, say on the low end, right, on the 5 times price to book, if you're putting in $100 into a REIT, you're really only buying $20 of real estate, right? And you get none of the tax benefits in a REIT because it's a C corp and it's taxed at the entity level. So you're really you're paying an 80% premium on the valuation, right? That the hope that it keeps going up over time, and to have the ability to liquidate at any point in time. Well, I'd actually kind of flip the script a little bit, and we looked at some research done by Bain Company, which is a huge global consulting organization, and they actually looked at the liquidity risk of alternatives, and actually found that it's not as much of a risk as people think it is. For one, most people overestimate their need for liquidity, right? So in a downturn, people like the comfort of feeling, hey, I have the ability to sell my stocks if things get really bad, and I have liquidity, I can generate cash if I need. But what most people think they need for liquidity is actually way less than they actually would need in most circumstances. And then the second thing is it's actually a huge challenge psychologically to not sell when you're down, right? One of the worst things you can do in a downturn or a stock market crash is to sell when you're down, right? But you have this inherent challenge of, I'm just going to, it's going bad, I'm going to pull my cards at the table. That's the worst thing to do. But when you're in a private investment, you don't have that option, right? You actually try to manage through it. And what happens is if you are working with a good operator and they've planned well, and they've gone through challenges before, and they have enough reserves, and they can even do a capital call if needed. There's ways to mitigate risk and kind of manage through the challenge, and then you kind of come out on the other side and generally in a much better position. And so I actually view the liquidity risk, which is the biggest knock on alternatives, is actually probably one of the bigger benefits, and actually shifting your mindset to long term versus just the short term kind of dopamine hit.
Dude, such great conversation there, Ben, on liquidity. And again, going back to, overall wealth strategy, right? So I agree. That is the knock, right, on alternatives, is you don't have the liquidity. But look, the market's down 30% this year. So, are you going to sell right now at a loss, or even on the flip side, let's say, market's up and it's doing well. I mean, you've got tax consequences,
Yep.
right? On the other side of that. So I would say that liquidity should actually be managed in a different way, which is part of your overall strategy. So
Yes.
what do you really need liquidity for? Is it that you want to have that nest egg that's 6 to 12 months of living expenses, for yourself and your family? That's great. Do you need something beyond that because you want to feel, even more insulated? Or let's say you want to build up some dry powder for the next opportunities. That's great as well. And I think it depends on, where that lies with each individual person. But we like to use the infinite banking strategy to do that, right? Which is a capital warehouse that people have complete control. You can actually become, your own bank and keep those reserves in there that are growing, compounding tax-free. You have other, additional benefits. You can gift it to your heirs tax-free. You can create a tax-free income stream later on. It's got, asset protection to it. So that is the capital warehouse of where you have the liquidity. So if you combine that then with the alternatives, it totally takes away that, issue around liquidity.
Yeah. I'm not as familiar on the infinite banking concept, but I've heard people use it, and obviously you're a big proponent of it. So it's cool.
Yeah, I've been using it with my wife, for the past 10 years. And like I said, that, that's where we keep our reserves, right? Our rainy day funds, our capital there. It's compounding at 5 to 6%, tax free, right? Which is really nice. And then, it's a great solution for passive investors where you have this cash flow coming in off of, multiple different alternatives, right? That are coming in. And a lot of people are still working. They don't need the cash flow. So what do? They kind of probably stick it in a bank account. It's not earning that much, but if you put it right into your capital warehouse, now you're making 5 to 6%. You have these other things, and then you build up your next tranche of whatever that is, 50, 100K, to be able to do your next investment. And over time, it adds some significant velocity really to your portfolio, as well as gives you back really a lot more control and power. So you don't have to be worrying about, is the market up or down, or stock or tax implications and such.
Yeah. Cool. Makes sense.
So Ben, let's jump in a little bit. So I know, we talked about oil and gas a little bit. Kind of tell us your thoughts on, macro trends with oil and gas right now, and how are you, what are you seeing?
Yeah. So, we just launched an oil and gas project. It sounds like you're launching one here soon as well. And, it's a space that we've looked at for a while, and have done a lot of due diligence on. It kind of gets a bad rap because, one of our partners said his experience with other people who've invested in there is, oil and gas is a deal where it's a liar on top of a hole, right? And it's kind of got a little bit of a bad rap because there's a lot of, bad actors, or, at least that was a perception. So you really have to do your due diligence. Number one, it's a lot more of a volatile investment because you're tied to commodity prices unless you employ hedging. But from a macro standpoint, it's really hard to argue against some of the trends that are going on right now. And some people, have an initial challenge against oil and gas investing because the big ESG and green movements, right? This is where we want to go. And it's very clear from, the political standpoint, both domestically and globally, that green is the way forward, right? But the challenge with that narrative is, the politicians somehow believe that we can magically transition over to green energy overnight, effectively, right? And that's just not realistic. There's a massive amount of challenges and headwinds to get to that point. I'm a big believer in green. I love the idea of that. I definitely want to do our part to reduce global warming and to reduce burning fossil fuels. But at the same time, I'm also a pragmatist and realize that there's this kind of meta narrative going on of green's the only way we have to make this transition, and then there's kind of the fundamentals that we're seeing, and every single person that's filling up their gas tank is seeing the disconnect, right? Of oil is very high. It's come down a little bit off the highs, but Goldman Sachs actually predicts by the end of the summer here, it's going to go back up. And it ultimately comes down to, there's not been capital investment, significant capital investment made into domestic oil and gas production really for the past 5 years. So the peak last of, investment capital into these producing wells was about 2015. And since then, it's kind of been on a pretty precipitous decline. And if you think about oil and gas, right, as, compared to real estate or another asset class, it's a depleting asset, right? So, whereas real estate's an appreciating asset, oil and gas, there's a limited amount of reserves wherever you are drilling or having wells, producing the oil and gas, and those eventually will run out. The reserves will run out. And as these wells age, you have to, basically keep maintenance capital invested into them to keep them producing at a high level, because these are very mechanically driven pieces of machinery. And if you're not, doing proper maintenance and putting new capital investment into it, it's going to decline naturally. And so what's happened is we've kind of, similar like in the real estate space, there's been a huge supply shortage of building. And, we weren't building a lot of single family homes for a long time. Also, it's kind of caught up with us. That's kind of the same thing that's happening in oil and gas. And you add on to that the kind of geopolitical things going on in Europe with the Russia-Ukraine war. Russia is a massive exporter of oil and one of the biggest ways that Europe gets its energy. But right now, no one wants to buy Russian oil for good reason, right? Because of what they're doing. And so it's created this kind of discount of the oil that's coming out of there. And then, you look at the global inventories of oil, that basically these are kind of the reserves that we have from excess drilling. And we're pretty much close to zero across the board. And it's a pretty, we kind of view it as a energy crisis. We released an episode called The Brewing Energy Crisis a week or two ago. Ironically, 2 days later, Wall Street Journal just released an article talking about America's new energy crisis, because it's not something that's going to be solved overnight, because this capital investment, it's a long cycle, right? It's not, again, you just turn the wells back on and you get more production. And then again, you kind of have this headwind of just the political landscape going on and trying to, punish these larger oil and gas producers, and giving them, different kind of taxes and things that are going to disincentivize the supply. And so you're basically having this, natural supply, lack of supply. Then you have the political landscape that's trying to reduce the supply, right? And then you have demand that has, in the past, 18 months, come back with vengeance from, COVID. People are traveling a lot more and wanting to get out, but it's even more than that. And so we actually think it's going to be long-term. We actually have an oil and gas economist coming on the podcast in a week or two, talking about long-term demand and supply trends. And I had a little quick conversation with him a few days ago, and he's basically saying we're going to see elevated pricing for the next decade. This is a mega trend that is not, a quick, we're going to have some volatility, and I'm sure there'll be some, points where it trades lower based on the kind of, short-term things going on. But at a macro level, on a long-term secular basis, we're at some pretty serious kind of supply challenged growth in the oil and gas space. So that's a very long-winded answer, but just brain dump on you with kind of some things we're seeing. And from an investment standpoint, right, it creates a lot of opportunity, especially these elevated prices. And if you can work with an operator that has a low break-even cost, and you can get pretty darn good cash flows. And there's other ways to kind of play with mineral interest versus working interest. But, another kind of thing that we are also kind of calling as another mega trend that we kind of see happening for the next several years is going to be inflation, right? And we can kind of shift over that if you want in a minute, but really, energy and oil itself is really the mother of all commodities, right? It's used, for gas and energy to produce, mineral drilling and exploration. It's used as a kind of a base material in a lot of different industries. And so if you have these elevated prices in oil and gas, it's going to naturally kind of indirectly increase prices of a lot of other consumer goods. And, I think we're going to be challenged to get inflation back to a manageable level for some time.
Yeah, really great insights, Ben. Just to tack on to that, a few comments. Like you said, this overall macro trend. I mean, essentially, there's just not enough global infrastructure to be able to support the demand. And oil and gas is such an intensive industry. I mean, there's so much, from the exploration side, what happens to actually getting oil out of the ground. It's very, very intensive and takes years to actually get there. So to try to keep up with that demand, even if we wanted to, turn on the spigot right now and be able to do that, we can't really do that, right?
Right.
So I think that really supports your thesis, right, of the overall just macro trend where supply and demand, right? I mean, there is just a huge shortage in terms of supply, and that's not going away, right? And I would also add, from the green energy perspective, I think everyone wants to do their part, with green, and I mean, we have to, right, to save our planet. But what a lot of people don't really realize is that these other things such as lithium batteries, wind and solar. Lithium, the amount of energy it requires to mine lithium is, I believe it's over 70%, right, that it takes to be able to mine all that ore. And that's all done with petroleum-based, equipment and products and everything
Yep.
to get that out. And the other thing that we're not seeing on that green side too is it's going to require a ton of energy to actually manage as these lithium batteries start aging, in 20, 25 years, right? Where do you put them? How do you dispose of them? That's going to create a significant, issue. So I believe that, people should do a little bit more research, right? If they're afraid from the green impact, how much petroleum-based energy goes into things like, batteries, and wind and solar and some of those other vehicles for energy.
100%. You make a great point on the lithium. We just saw a stat the other day and kind of talking about this kind of forced transition to green energy. Lithium is a huge component of battery technology and what's used in electric vehicles. And so, right now, just real simple numbers. I think the global percentage of cars that run on electricity is less than 5%. But right now, production of those cars is using, I think it's 60 to 70% of the global lithium inventory.
Wow.
So that 5% is of cars that are currently electric is using 70% of the current mining of lithium in the world. So you just do simple math. If we want to go full transition to green energy in the next 10 years, there's no way we can do that just on simple math of lithium production. And so we have to massively increase the lithium mining that's going on, which is very dirty business, to be completely honest, and does require a lot of fossil fuels to do so. So it's just these really, it sounds really nice and green sells really well, and ESG is super sexy, right? Everyone wants to be part of the green movement, which we do too, right? We're not arguing against green. We're arguing against the brushing over the facts that are kind of telling this one narrative that's actually producing a whole other set of consequences. Another kind of big trend that we're seeing, in that we're not hearing a lot of people talk about, but I think is kind of obvious to a lot of people, is a deglobalization trend, right? And so another big vertical and asset class that we kind of believe is on another mega trend is going to be industrial. And some of the things going on in the market right now, domestically at least, is a deglobalization. So we've kind of had the kind of e-commerce trend going on for the past 10 years. That's really increased the need for industrial real estate, to basically be warehousing, be distribution, those kind of things, as more people are buying things online. That trend has started to kind of slow a little bit. I mean, you saw Amazon, this kind of big headlines. Amazon, canceled all the square footage of what they were doing in industrial. But the reality was, they just didn't execute on like 5% of the new industrial that they were planning on doing. So they're
Yeah.
still increasing by a huge number, but they're just, decreasing that increase by a slight number. And
Yeah.
that got all the headlines, right? But it's, there's kind of this new trend going on in the deglobalization, which is basically the onshoring of inventory and the onshoring of manufacturing. So as when I was in school, 15, 20 years ago, the big thing everyone was talking about was just-in-time inventory and globalization. We're driving down costs and by kind of globalizing the supply chain, right? And so you can, get this from China, get this from Taiwan, get this from, Mexico. And by doing that, the labor market's a lot cheaper there, so you can drive down costs. And, that's, very positive for a consumer. Well, what's happened, as we all saw in COVID, was the supply chain got really challenged. And, for example, the auto manufacturers such as Ford, they're trying to produce all these new cars. They're having continued demand for their new automobiles, but they can't get the computer chips needed to actually finish production. So they have all these cars that are pretty much 90% there. They just need this computer chip that they're shipping, I believe, from Mexico is where they were getting it from, but the supply chain was limiting the amount that they could get. Well, that chip is a insignificant cost to them relative to the overall production of the cost of the car, but they can't get it and they can't finish it. So how much is it worth Ford, for example, to have the inventory domestically in the US and pay a little bit more for that, but now they get to be able to finish the cars and actually generate revenue, right? It's very, very valuable. We're seeing that across the board. We're actually seeing a lot of these big, manufacturers, a lot of big other companies that are bringing back inventory reshoring to the US to reduce supply chain dependence. And then on top of that, we've seen the labor market costs rise in a lot of these kind of more third world or second world countries that, historically was, you get a really big delta on your labor costs savings by producing it abroad. But it's actually kind of normalized where the US manufacturing market is a lot more attractive now. So we're seeing these kind of, deglobalizing trends, and it's something that, we think is going to benefit many industries, including from a real estate standpoint, industrial, which is another vertical that we really like.
Yeah, very interesting. So why don't we transition into that? You talked about inflation a little bit, having some insights onto that. I know everyone's trying to pull out their crystal ball right now. So what are you thinking from that perspective?
Yeah, well, I think I kind of alluded to it. If you break down the components of CPI and what's causing, the bigger drivers of CPI, the number one there is energy. So we've seen a little bit of it come off recently, the highs, but for all the reasons we just talked about, we don't see energy prices coming back anywhere to 2019 levels for some time. And that's going to have an indirect effect in many, many other industries because it's used as a base material for production of a lot of things. And it's going to drive inflation. I think it's going to plateau and probably come down a little bit. 9.1% was the last reading, which was extremely high. But it's a little bit of a lagging indicator, right? I think the next reading will probably be a little bit lower than that. But if you think about the Fed's mandate of long-term inflationary, numbers they want to see is kind of around the 2 to 3%, right? That's right. Their mandate. That's what they're going for. We're way off from that. And I think we could probably normalize somewhere in the 5 to 6% range, as some of these kind of initial shocks kind of get out of the system, but we're going to have elevated prices for a period of, we think, a couple of years, possibly as many as 3 to 5 years. If you just look at energy costs as primary component of that, alongside many other factors going on. So we think inflation is going to remain high. Obviously the Fed is trying to slow demand a little bit by increasing interest rates, which, will probably have some effect on that. But, boots on the ground, we're still actively trading deals. It does not seem to be slowing down the real estate market too dramatically. I think some deals are kind of at a disconnect, but it still hasn't fully, done what I think they're looking for. So I think that could be a headwind we have with interest rates continuing to rise. What, the Fed's position on that is, historically been pretty dovish, but they've kind of all of a sudden turned very hawkish. And so it's a little bit hard to kind of read where they're going to go. Will they let us go into recession? Will they keep us there for a while? Will it be like the period of the 1980s where you kind of have, stagflation, which is a word a lot of people are throwing around. I don't know. I think, my gut says that if things get bad again, they'll drop rates, again, and help keep liquidity in the market, because that obviously seemed to help a lot during COVID. So yeah, I think, from a pure inflation standpoint, I think we're going to see it for a while, probably not as high as we have, but it's going to continue to go. So what we're doing, we're positioning ourselves is buy inflation protective assets, buy assets that are going to benefit from inflation. Real estate, generally is a really good asset. Residential real estate is probably the most highly correlated to inflation. So we love multifamily, we love single family, we love short-term rentals, we love long-term rentals. So we're kind of, trying to get in a position to benefit from what we think is going to continue on for a while.
Yeah, for sure. Ben, if you could just give one piece of advice to listeners about how they could accelerate their wealth journeys, what would it be?
Oh, good question. And I think all the things we've said, to sum it up, would be to think differently about your wealth allocation, right? Get out of the public markets, or don't get all the way out if you like it, but get into some of these other asset classes that are going to benefit from the things going on, right? We at Aspen believe there's always an opportunity, right? Even if there's challenges, even if there's economic recession, there's always going to be an opportunity if you know where to look, if you know what trends to look for. And so, turn off the noise from the media that's always, changing the headlines of what's the latest thing, and look at the underlying data and find places that are going to benefit from long-term trends going on. And, the power of compounding, as I'm sure you talk a lot about with your listeners and your clients, if you can just compound and not have, big tax hits, not have big volatility hits, that is probably one of the biggest ways to grow your wealth very, very rapidly. And there you go.
Yeah. Awesome. Thanks for that, Ben. Really appreciate you coming on the show today and sharing your insights. I know everyone's going to love the updates. If people want to get in touch with you, learn more about what you're doing, what's the best way?
Yeah, our podcast is Invest Like a Billionaire. You can go to thebillionairepodcast.com and tune into some of the episodes. And then if investors want to check out some of the offerings we have, we've got aspenfunds.us for kind of our investment private equity firm.
Awesome. Thanks again, Ben.
All right. Thanks, Dave.